Good afternoon and happy Thursday, everyone. It is Scott Wohlers with River Place Capital. It is Thursday, January the 4th, and want to wish everyone a happy new year. Thanks for tuning in. We're going to talk a little bit about how markets finished up the year last year and kind of talk a little bit about what we see happening this year. If we see some volatility coming to the index level and where we kind of see markets moving this year and some opportunities that we foresee. So the S&P 500 finished the year with 9 consecutive weeks of gains, finishing up the week last week up 32 basis points or 0.32%. The mid-cap index, however, as measured by the S&P 400, was off 21 basis points or 0.21%, and the small caps as measured by the S&P 600 were down 10 basis points or down 0.10% on the week. So the S&P 500 surprisingly, amazingly finished the year up over 24%. But if you weren't quite there, that's okay, and we're going to explain. We've been talking about why maybe you haven't been keeping up with the index itself. It's been very narrow, with the growth index being up over 41% year to date, while the value index was only up a little bit over 8, roughly 9%. So you have 32% divergence between the two sectors, which is historic that we haven't seen, I believe, going back 50 to 60 years, is the largest divergence we've seen between the growth and value sector in the S&P 500. So the equal weight S&P 500, so if you took the S&P 500 and every stock carried the same weighting in the index, was up 11%. So again, that's 13 basis points behind where the index finished year to date. And this is very important as we head into this year. So we ended the year, like I said, on 9 straight consecutive positive weeks in the S&P 500. So it's no surprise that as we enter into 2024, that the first thing that we're doing is taking a little profits off the table after such a great run in the equity markets and such a great year run for a lot of tech stocks in the equity market. And what's important about this is that Magnificent Seven that we talked about last year that really led the market higher as investors got scared about growth prospects, we got scared about recession. As we end the year of 23, the consensus is that we're going to skirt a recession. Now, what we believe is we expect to see a growth slowdown. We don't expect to see a full-on recession in the United States, more of a return to normalcy back to 2018, 2019 run rates where the economy is healthy and strong, but is not doing anything parabolical, but a very fundamentally strong economy, as well as we have government stimulus to help energize and add juice to the economy as we enter into this year. So the thing that we really can see happen, and we've seen it really happen the last 8 weeks of the year, going back and forth, and we've seen it so far this year, is a lot of the profit taking has been in your winners of last year. So what you're going to see potentially is at the index level a lot of volatility happening, both up and down, maybe more on the downside or maybe some treading water as these large mega cap tech and communication services stocks are sold as source of funds, or you take profits, because that's the responsible thing to do after you're up over 100% in Meta and other things like that, is to take some off the table and to allocate that out to others who have not performed. And you're seeing that take place in the market. So on Tuesday it was a down day, but if you looked at the equal weight S&P 500, is actually positive. Now that reversed yesterday and everything was just sold off yesterday, but again, that's just profit taking after an extended run. So we see the volatility being here in 24, up and down. It is an election year. The last 16 times you've had a presidential re-election campaign year, the S&P 500 has finished positive for the year. So that's just some historical reference for you heading into this year. And a lot is going to go on from a macro level to a political level that's going to cause volatility on the index level. But what we see is these sectors that were forgotten about last year, your value sectors, your healthcares, your energies, your financials, your industrials, really have the opportunity on the large caps to really add some juice to your stock portfolio, and you can see the index level itself not do much. Because remember, you're going to sell that 30, so the Magnificent Seven makes up 30% of the market cap weight of the S&P 500. So you're going to sell those, and you're going to buy the ones down here that you can't, that's under the water. And so you're going to have the index come down or stay stagnant while the average stock is coming back up to meet. We call this in our industry what is called reversion to the mean. Whenever you have that historic divergence between growth and value, something has to give at some point. You can't run parabolic like that forever. So sometimes we try to overcomplicate things, and it can be as simple as there is just a sector rotation. And we do really believe that we're going to see new leadership emerge this year in healthcare, utilities, and energy being safe havens as people take some profits from growth and put them into your more cyclically oriented sectors. So as always, if you have questions about how to navigate 2024, or you're getting ready to do a plan or putting your plan together for this year, give us a call. We'd love to talk to you. And as always, to start the year, River Place Capital does give away free financial plans to anybody who would like to take advantage of that. So if you'd like to take advantage of that, give us a call. We'd love to talk to you at 904-346-3460. Or as always, check us out online at www.riverplacecapital.com. Have a wonderful rest of your week, everyone. Thanks so much.